Our marketing analyst this week is Darin Newsom from DTN. We talked to Darin here on Thursday morning. You presented today on the potential for an end in the demand market in grains at a time, mind you, when there's a growing population, there's a push for renewable fuels. So why must you rain on this parade, Darin?
Because somebody has to. And it's actually a question I get asked frequently. You know, reporters from both coasts, even some from the interior, wanting to know if this demand market, this incredibly strong ag industry, ag business cycle that we've seen over the last 5-6 years is going to come to an end. There are a lot of predictions that that's going to happen. That when we get to the end of 2012, that's going to be the end of this strong cycle that we've seen in agriculture. I'm not convinced, but we wanted to lay out the argument, both pro and con, why that's being made.
So why are some of the concerns there? What are some of the things that make people think that it is ending?
The biggest reason, and can't go all the way back just to the the annual forum from USDA here last week or so, but more so that the market is high priced and that it just cannot sustain itself, that we're seeing some sort of ag bubble exist, and that if corn starts to break, and corn probably, and their argument is corn needs to break to make other industries stronger, then you're going to see the other grains start to move lower. You're going to see all of the industries tied to corn start to come down. A lot of talk that ethanol isn't going to be able to maintain itself with the end of its subsidy situation, that renewable fuels is certainly going to come up for argument, debate. So all of these things are tying together, saying this is going to be the year that this thing comes to an end.
Let's talk a little bit more about ethanol, because we watched the expiration of the blenders credits in late December. How confident are you now that this industry can not only survive, because survival is one thing, but is it able to thrive?
Two different questions, great questions. Number one, it will survive. Right now it looks like it certainly is going to survive with the situation that we have now. Thriving is going to be more difficult because we're seeing overall gasoline demand coming down. We haven't met the type of demand that we saw in late 2007, early 2008, ever since the economic bust happened in 2008 through early 2009. Gasoline demand has not come back, and there's a few different reasons for that. More fuel-efficient cars, less driving, and we're still dealing with an unemployment situation here in the United States. So all of these have reduced total gasoline demand, and that means not as much actual demand for ethanol, meaning not as much demand for corn from ethanol. So thriving could be difficult if we don't see the overall gasoline demand start to go back up. Surviving, I think it's strong enough to do that without the blender's credit.
Let's attack that growing population. How can we say that there might be a threat to demand if we're still seeing a massive population increase by 2050, 2025?
I don't see that argument at all. They make it saying that we just can't sustain this type of demand growth. We look at the demand charts. We showed them in the seminar today, both domestic and globally. Corn demand just continues to go up year to year. It doesn't matter what the global economy does. We're seeing very strong demand growth, and there's really no reason outside of an anomaly, outside of some sort of chaos effect event, some butterfly event, that we would expect demand to start coming down. It's just too strong, and population's going up, demand's going up.
So what are some of the keys to look at if demand would be ending? You mentioned today investment interest, you mentioned future spreads to look at. What are some things there to key off of?
Well, again, it all comes back to my way of looking at the markets, and that's through its structure and the two sides you just mentioned. What are the investors doing? Is there a reason for the investors to start moving to something else? We're seeing the dollar starting to change. It's not as weak as it was in past years, so that's going to start pulling some money out of commodities because the fear of inflation is gone. We also have investors coming in on the idea of tightening supply and demand. Unfortunately, for the markets themselves, the strength of the markets themselves, since early 2011, that money has been coming. It's been coming out faster than it's been going in. So certainly that is a concern that they don't return the same size that they've been in the past. Fundamentally, yes, if we want to look for some signs coming along the road, we have to keep an eye on the future spreads or the price relationship between these different contracts. That'll be a key. That and the basis, the difference between cash and futures, as to when the commercial side is also giving up on this market and demand, the overall demand situation could be starting to slow.
You said today you're confident in the demand market through August. If it would falter, when do we start to see that price come into play?
That could actually start occurring, say, mid-June, mid-July through August, when we get that tipping point where we're starting to focus more on what is expected to be an enormous, a record-sized corn crop this year, plantings of 94 to 95 million acres, possibility of 164 bushels per acre. When we turn our focus to that and not the tight old crop situation, the tight supplies domestically and globally, that's when this top, at least this short-term top, could occur.
I want to ask you a quick question on soybeans.
Yes.
How closely is that demand tied to China?
Very closely. Demand, China is the demand that everyone's
Right.
fighting for. And this year, with reduced production in both Brazil and Argentina and other parts of South America, more of that's going to come to the United States. So the focus will almost be entirely on Chinese demand.
As we look at the two evils, potential evils or potential downturns in the market, one being demand, the other being a potential collapse in Europe, which may be staved off for X number of months now. Which of those two is a greater threat?
The economic situation in Europe is a threat, but let's go back to what we said just a few minutes ago, that both corn and soybeans have seen global demand going up despite some of the problems going on in Europe. So yes, we're going to keep a close eye because of the effects, the ripple effects that could have on global banking. I think that's where the real threat in Europe lies. As far as China goes, if it were to say, our demand's going down, we're going to go somewhere else to get our beans, we're going to change our protein source, that's the real threat. I don't see it as a real threat right now, but it certainly is a potential threat out there.